Welcome to Talk Tickers. Let us set a scene that is highly relatable if you spend your days deep in the trenches of financial modeling.
Oh, absolutely. The classic analyst setup.
Right. So imagine you've got this dual monitor setup. On the right screen, you have a massive Excel workbook open. You are building a relative valuation model, basically a comps sheet.
Yeah.
And you're comparing a massive US-based industrial giant with a European competitor. Now, on the surface, the European peer looks, well, absolutely incredible.
Like a dream stock.
Exactly. I mean, their operating margins look far superior, their asset base looks incredibly robust, and their operating cash flows are just significantly higher. You run the multiples, and the European company looks like a screaming bargain.
It's exactly the kind of moment that makes an analyst's heart beat a little faster.
Yeah.
You sit back and think you've just found the alpha.
Yeah, you're ready to sprint to your portfolio manager's office and just pound the table for a massive buy rating based on sheer operational dominance.
Right.
But before you do that, you have to stop, take a breath, and ask yourself a really critical question. Are you looking at a better business, or are you just looking at different accounting?
And that is the exact trap that catches both seasoned market practitioners and candidates sitting for their CFA exams.
Yeah.
Every single year.
Yeah.
You simply cannot take reported numbers at face value across different global jurisdictions. Doing so basically guarantees flawed, comparable analysis and, frankly, fundamental valuation errors.
Which brings us to the core of this deep dive. We are focusing on the foundational and mechanical differences between U.S. generally accepted accounting principles, US GAAP, and International Financial Reporting Standards, or IFRS.
Right. And just to be completely clear on our scope here for you listening, we are not going to sit here and recite esoteric boilerplate compliance rules.
No, nobody wants to hear that.
Exactly. We're going to look at the major levers that physically swing EBITDA, net income, asset velocity, and cash flow presentation.
Because for CFA candidates, I mean, this is the absolute core of financial statement analysis. It's FSA 101.
It really is. And for the practitioner out there building a discounted cash flow model or running an EV to EBITDA screen, understanding these differences is the only way to arrive at the underlying economic reality of a business.
So true. But before we tear down the specific line items like inventory and capitalized development, we really have to understand the philosophical architecture that creates these differences in the first place, right?
Yeah, the foundations. Historically, if you open like any introductory finance textbook, the fundamental architecture that creates these differences is described kind of like this. IFRS is principles-based, providing a broad conceptual framework that requires significant management judgment to ensure the statements present a true and fair view.
Right.
And US GAAP, on the other hand, is traditionally described as rules-based, relying on heavily prescriptive, bright-line tests, quantitative thresholds, and highly specific industry guidelines.
Okay, I have to stop you right there because the whole principles versus rules thing feels like a tired textbook cliche at this point.
Oh, I totally agree.
Right. Anyone who has actually modeled these companies recently knows that convergence efforts over the last decade have completely blurred those lines.
Absolutely.
Just look at US GAAP's ASC 606 for revenue recognition. I mean, it is incredibly principle-based. It's almost entirely about management judgment regarding when control of a good or service transfers to the customer rather than the old, rigid, industry-by-industry rules we used to have.
That's a very fair point. The standard setters in Norwalk and London have they've borrowed heavily from each other over the years.
Right. And conversely, IFRS has developed incredibly dense rule-like implementation guidance for complex areas like financial instruments.
Yeah, it's not the Wild West.
Exactly. So for you listening, do not rely on the principles versus rules heuristic to save you when you're adjusting a model. It won't. You really must know the specific mechanical differences. I mean, isn't that heuristic basically dead?
For the practical analyst, yes, it is completely dead. The mechanics are what matter. And one of the most important conceptual mechanics to understand right out of the gate before we even touch a balance sheet is the materiality divide.
Materiality meaning, does this piece of information actually matter to the person reading the financial statements?
Precisely. Under IFRS, materiality is explicitly entity-specific.
Okay.
So information is material if omitting it, misstating it, or obscuring it could reasonably be expected to influence the decisions that primary users make based on those specific financial statements. It relies heavily on the qualitative nature of that specific company.
So it's very focused on the individual firm. What about the U.S. side?
Right. Under US GAAP, materiality is heavily influenced by SEC guidance and decades of Supreme Court precedent. The standard is whether the information alters the total mix of information made available to a reasonable investor.
Okay, but how does that actually play out in the real world? Because where that materiality divide becomes incredibly practical is how standard setters force companies to correct their historical errors.
Yes, the error correction mechanics.
Right, like when a management team finds a misstatement from a prior year, say, they've been messing up their depreciation math for a while. How do they measure if that error is big enough to force a massive restatement?
That is where US GAAP gets very rigid. The SEC requires a specific dual method for evaluating prior year misstatements, and analysts really must understand both prongs of this test.
Okay.
You have the rollover method and the Iron Curtain method.
Walk us through the math on those because, the names sound like Cold War espionage tactics.
They do sound a bit dramatic, don't they? Let's start with the rollover method. This method quantifies the error based on the effect it has on the current period's income statement.
This is just looking at this year?
Strictly at the flow of money this year. Imagine a company has been under-depreciating a massive piece of factory equipment by $10 million a year for the last 5 years.
So they've been artificially boosting their pre-tax income by $10 million every single year.
Exactly. The rollover method looks at year 5 and says, okay, the error in this period's income statement is $10 million. If $10 million is considered immaterial to this year's massive net income, it passes the rollover test.
Interesting.
Yeah, management might argue they don't need to issue a restatement based on that method alone.
But then you hit the Iron Curtain method, and this is where the historical sins kind of catch up to you.
Precisely. The Iron Curtain method quantifies the cumulative error sitting on the balance sheet at the end of the current period, regardless of when the error actually originated.
Okay, so they're looking at the total bucket.
Right. So taking that exact same example, the Iron Curtain method looks at the balance sheet and says, wait a minute, accumulated depreciation is understated by $50 million in total.
Because it's $10 million a year for 5 years.
Exactly. And if $50 million is material to the total balance sheet, the error is material, period. Even if the current year's $10 million flow wasn't a big deal to the P&L. Yeah, a US GAAP registrant must apply both methods. If the error is material under either the rollover or the Iron Curtain method, they have to correct it and potentially restate prior financials.
So even if the error this year is tiny, if the bucket of historical errors is full, they have to take the hit.
Yes. This dual requirement, which was introduced via SEC Staff Accounting Bulletin 108 years ago, ensures that companies cannot just let immaterial annual errors quietly build up into massive balance sheet distortions over a decade. It basically forces a reckoning.
That makes perfect sense. It keeps the balance sheet anchored to reality. Now, speaking of the balance sheet, let's actually dive into the physical layout of these documents.
Let's do it.
Because the moment you open an IFRS annual report, something looks immediately wrong if you're used to American filings. The balance sheet is practically upside down.
It really is visually jarring the first time you see it. Under US GAAP, as we all know, assets are presented in decreasing order of liquidity. You see cash and cash equivalents at the absolute top of the page. Then you move down through short-term investments, accounts receivable, and inventory.
Standard stuff.
Yeah, and eventually you land at the long-term, highly illiquid assets at the bottom, property, plant and equipment, and goodwill.
But IFRS flips that completely. Under IFRS, you will frequently see assets presented in increasing order of liquidity.
Exactly.
The non-current assets, the heavy machinery, the factories, the intangibles are listed first. And cash is just buried at the very bottom of the asset column.
Yeah, a lot of people dismiss this as purely presentational, which technically it is. It doesn't change the underlying math of the company.
Right. A dollar is a dollar.
But it reflects a deep historical and geographic bias in how these markets developed. U.S. capital markets historically prioritized short-term solvency and creditor protection.
How so?
Well, the early American stock market was heavily driven by banks and bondholders who wanted to know one thing immediately. If we call our loans today, can you cover your short-term liabilities?
So liquidity is presented first. Cash is king.
Exactly. Cash is king in America.
And the European markets.
European markets historically prioritized long-term industrial asset value. The focus was on the foundational productive capacity of the enterprise.
That makes sense.
Remember, a lot of these European conglomerates were controlled by long-term industrial families or even state interests who were thinking in generations, not quarters.
Yeah.
So the fixed assets, the actual physical engines of production, take the premier position on the page.
It is a perfect reflection of the underlying market psychology. It's fascinating how accounting formats basically encode financial history.
It really is.
But let's move from the balance sheet over to the income statement, because there is a massive shift coming down the pipeline for anyone analyzing IFRS companies. We really need to talk about IFRS 18, which becomes effective in 2027.
Yes, this is huge.
This is going to fundamentally change how analysts scrape data.
It is a profound change. IFRS 18 is going to mandate specific, standardized categories in the statement of profit or loss, operating, investing, and financing. But the real earthquake here is the new requirement regarding management performance measures, or MPMs.
MPMs. Basically, the custom non-GAAP metrics that companies love to invent.
Exactly. Currently, management teams love to present custom metrics in their press releases and glossy investor presentations. Things like adjusted EBITDA, or core operating profit, or underlying earnings.
Or my personal favorite from the tech boom, community adjusted EBITDA, where they just added back every single expense they didn't like.
Right, exactly. Under US GAAP, the SEC heavily regulates these non-GAAP measures via Regulation G. You can't be misleading. But crucially, those custom metrics live outside the actual audited financial statements.
Right.
The auditor signs off on the GAAP net income, not the adjusted EBITDA in the slide deck.
So think about it like a student grading their own homework. Management has always been able to invent a custom metric, exclude millions in restructuring costs that somehow happen every single year, grade themselves an A+, and put it in their investor deck.
But IFRS 18 is essentially forcing the company to bring that self-graded homework to the principal's office.
Oh, wow.
It will force companies to disclose their MPMs and mathematically reconcile them back to the closest IFRS-defined subtotal directly within the audited notes to the financial statements.
So the independent auditor actually has to look at the exact mathematical formula management used to create adjusted EBITDA and sign off on the reconciliation.
Yes. It brings the custom metric inside the audited boundary. It bridges the gap between management's optimistic commentary and the audited reality.
That is massive.
Analysts are going to have a field day with the transparency this provides into exactly what cost management is trying to pretend don't exist.
That is going to be incredibly revealing. But while we wait for 2027, we still have to deal with the most manipulated statement of them all today, the cash flow statement.
Oh yeah, the cash flow statement.
This is an area where comparable analysis breaks down entirely if you are just pulling raw data from a terminal without paying attention.
The mechanics of cash flow classification are famously rigid under US GAAP and notoriously flexible under IFRS.
Right. Let's lay out the American rules first. Under US GAAP, interest paid, interest received, and dividends received must be classified as operating cash flows.
Right.
And dividends paid to your shareholders are strictly financing cash flows. There is no debate. It is rigid.
But under IFRS, companies are given a menu of choices.
A menu.
Yeah, interest and dividends paid can be classified as operating or financing cash flows. Interest and dividends received can be classified as operating or investing cash flows.
Wait, so you're telling me an IFRS company can just choose where to hide its interest payments to make its operating cash flow look better?
That is exactly what I'm telling you.
Yes.
The practical application of this flexibility is enormous for valuation. Suppose you are comparing the cash flow from operations CFO yield between a U.S. company and an IFRS company.
Okay.
The U.S. company is inherently penalized in its CFO because it is forced by GAAP to deduct its interest expense right there in the operating section.
Because GAAP views interest as part of the cost of running the day-to-day operations.
Correct. But the IFRS company might look at that and say, well, interest is a cost of how we are capitalized, not a cost of our operations. So they choose to push interest paid down into the financing section of the cash flow statement.
Oh, I see.
Mathematically, this artificially inflates the IFRS company's CFO relative to its exact U.S. peer.
So if you do not standardize these classifications in your model, you will look at the IFRS company and think, wow, their cash conversion is incredible. They are generating so much cash from operations.
Yeah.
But they aren't. They just move the interest expense below the line.
Exactly. As an analyst, you must go into the IFRS cash flow statement, look at the notes, identify exactly where they categorize interest paid, and if it is sitting in financing, you must manually deduct it from CFO to create an apples-to-apples comparison with the U.S. GAAP firm.
Wow.
If you are calculating free cash flow to the firm versus free cash flow to equity, this misclassification will completely wreck your DCF model.
Standardizing those cash flows is step one of any comps analysis. But cash flows don't just appear out of thin air. They are generated by the physical assets the company owns.
Right.
Which brings us to the actual physical engine of the business. Inventory and long-lived assets. Let's move into that engine room.
The physical stuff. Let's start with inventory. And one of the most famous, historically entrenched divergences in all of accounting, the LIFO prohibition.
Yeah, so US GAAP permits companies to measure inventory costs using first in, first out FIFO-weighted average cost and last in, first out, or LIFO. But IFRS strictly prohibits the use of LIFO. It is simply not allowed.
To understand why this matters so much to valuation and fundamental screening, we have to walk through the mechanics of LIFO during an inflationary environment.
Okay.
And given the global inflation we've seen recently, this is highly, highly relevant.
Let me give a quick example. Imagine a grocery store using LIFO for milk. The physical flow of last in, first out means they would keep selling today's fresh milk delivery to customers, while the older gallons of milk just sit in the back of the fridge turning into cheese.
Which is disgusting.
Right. It's completely absurd from a physical standpoint. No factory manager sells their newest inventory first while letting the old stuff rot in the back of the warehouse.
It is an economic fiction. But it is an economic fiction that U.S. companies absolutely love because of how it impacts the income statement.
How so?
Well, under LIFO, the most recently acquired, most expensive units of inventory are the ones matched against current revenue and cost of goods sold.
Right. If you bought widgets for $1 in 2010 and you buy widgets for $5 today, LIFO says you apply the $5 cost to today's sale.
Correct. When you match those newest, highest costs against revenue, your cost of goods sold is mathematically higher. Consequently, your reported gross margin is lower and your reported net income is lower.
And why on earth would a company willingly choose an accounting method that makes their net income look worse to Wall Street?
Because the IRS requires that if you use LIFO for your tax returns, you must use it for your financial reporting. Because net income is lower under LIFO, your current corporate tax liability is lower.
Taxes.
Always taxes. You are shielding cash from the government. That tax minimization is the primary real-world economic reason U.S. companies like to use LIFO.
But the trade-off is that it creates a massive distortion on the balance sheet.
Exactly.
Because the newest, most expensive costs are expensed through the income statement, the oldest, cheapest costs remain sitting on the balance sheet in the inventory line item. Over decades, a company's carrying value of inventory can become entirely detached from current economic replacement costs. You might have inventory sitting on the books at 1980s prices.
It artificially suppresses the asset base. IFRS rejects LIFO on conceptual grounds precisely because it distorts the balance sheet so severely and does not reflect the actual physical flow of goods in almost any industry.
So if you are an analyst comparing a U.S. LIFO firm, like a heavy equipment dealer, to a European FIFO firm, you have to do the math to convert the U.S. firm to FIFO. You can't just compare them as is.
You have to do the conversion.
Yeah.
For those who need a quick refresher on the mechanics, you take the LIFO reserve, which is the difference between inventory calculated under FIFO and LIFO, and which the SEC requires U.S. companies to disclose in the footnotes, and you add it back to the inventory balance on the balance sheet.
Okay.
That steps the inventory up to current replacement cost. Then you subtract the change in the LIFO reserve from cost of goods sold to normalize earnings.
Yeah.
Only then can you accurately compare gross margins and asset turnover ratios.
And you also have to adjust deferred taxes and equity, but we won't drag the listener through the journal entries on that today.
No, let's spare them that.
But what happens when the bottom falls out of the market and that inventory is suddenly worthless? Say, a semiconductor company sitting on chips that are suddenly 2 generations obsolete.
You have to write it down. Under US GAAP, you measure inventory at the lower of cost or market value if you're using LIFO or the retail method, and lower of cost or net realizable value for FIFO. IFRS universally uses the lower of cost or net realizable value.
But the real divergence isn't in the initial write-down, it's in the recovery.
Crucially, yes. IFRS allows reversals of inventory write-downs if market conditions recover. Say the price of those semiconductors suddenly spikes because of a supply chain shock.
Like we saw a few years ago.
Exactly. Under IFRS, you can write the value of that inventory back up, capping it at the original cost. US GAAP strictly prohibits reversals.
Really?
Once you write it down under US GAAP, that new lower value is the permanent cost basis. It doesn't matter if the market price triples the next day.
That prohibition of reversals under US GAAP is a massive philosophical difference. It applies not just to inventory, but to property, plant, and equipment as well. Which brings us to the next massive divergence in the physical engine. How we value the factories, the land, the heavy machinery.
Right. US GAAP mandates the cost model for PP&E. You carry the asset at its historical cost, minus accumulated depreciation, minus any impairment. As you said, it is a one-way street. The value can only go down.
Yeah.
IFRS, however, allows an accounting policy choice. A company can choose the standard cost model, or they can choose the revaluation model.
And the revaluation model fundamentally alters how you view the balance sheet. If an IFRS company uses this model, they can periodically write up the value of their PP&E to fair value, assuming it can be measured reliably.
Let's use a tangible example. Imagine a German industrial company that bought a massive plot of land outside Munich in 1980 for the equivalent of 10 million euros.
Okay.
Today, that land is worth 100 million euros. Under US GAAP, a comparable American company would still carry that land at the 1980 purchase price. The balance sheet is completely blind to 40 years of appreciation. Under IFRS, the German company can revalue it to the current market price of 100 million.
But wait, where does that 90 million euro gain go? It can't go through the income statement and boost net income, right? That would be insane. They haven't actually sold the land.
Right. It bypasses the income statement entirely. It goes straight to the equity section of the balance sheet, specifically into a bucket called Other Comprehensive Income, or OCI, as a revaluation surplus.
For those who need a quick refresher, think of OCI as a holding pen on the balance sheet for gains and losses that haven't actually been realized yet. It keeps phantom unrealized gains out of the current year's earnings, so management can't pay themselves bonuses on property appreciation they haven't cashed in on.
That is an excellent way to put it. But as an analyst, you must extrapolate what this does to your fundamental ratios.
Right.
If an IFRS company revalues assets upward, their total asset base increases and their equity base increases.
So mathematically, this completely crushes their return on equity and return on assets ratios.
Exactly. The numerator, the net income, doesn't get the benefit of the gain. But the denominator, the total assets or total equity, swells massively. Suddenly, the company looks like it's generating a terrible return on its capital. Furthermore, if the revalued asset is depreciable, like a factory, because the carrying value is now higher, future depreciation expense will be higher. That higher depreciation will drag down future net income.
It is an optical illusion of a profitability decline. The company isn't actually performing worse. The economics haven't changed. They just restated their capital base to reality.
Yes.
As an analyst, if you are screening for ROIC or ROA across a global universe, you must manually strip out this revaluation surplus from the IFRS company's equity and assets and reverse the excess depreciation from their P&L to put them on a level playing field with a U.S. peer using historical cost.
Precisely. You have to strip away the accounting policy choice to find the operational truth.
Okay, so while physical assets like PP&E represent a company's past investments and present production capacity, research and development represents its future.
Yeah, the future.
And this is where the two standards diverge most violently in terms of philosophy and balance sheet impact. We're moving from the physical stuff to the abstract ideas, the innovation engine.
Let's define the philosophical divide here because it is stark. Under US GAAP, all R&D costs are expensed as incurred on the income statement.
Right.
There are very narrow exceptions for things like software development, but generally, if you spend $1 on research today, it hits the P&L today, period.
Under IFRS, research is expensed immediately, just like US GAAP. But development costs must be capitalized as an intangible asset on the balance sheet if specific, strict criteria are met.
Those criteria are a very high bar. You have to demonstrate technical feasibility, the intent to complete the asset, the ability to use or sell it, how it will generate future economic benefits, and the ability to reliably measure the expenditure.
It is a profound difference in how we view innovation. Look at it this way. US GAAP treats R&D like buying lottery tickets. You expense the cash immediately because the payout is highly uncertain. You don't put a stack of scratch-off tickets on your balance sheet and call it an asset.
That's a great analogy.
Thanks. IFRS, however, treats development like building a house. In the early stages, surveying the land, drawing up blueprints, testing the soil you expense it, that's research. But once the foundation is poured, the permits are cleared, and you know the house won't collapse, you start capitalizing the bricks. You are building an asset.
That is a perfect analogy. And to see the sheer magnitude of this difference, we have to look at hard numbers. Let's bring in a concrete case study. C&H Industrial.
Okay, let's look at C&H.
C&H is a massive global player in agricultural and construction equipment. To give you a sense of scale, in their 2024 financials, they reported roughly $14 billion in ag revenue, $3.1 billion in construction, and $2.8 billion in financial services.
Wow. Okay.
They are a capital-intensive, highly innovative manufacturer. Think autonomous tractors, precision agriculture software, heavy machinery.
Let's look at their mechanics in action for the 2024 fiscal year. C&H had $727 million in standard R&D expenses. These were early-stage research costs, and they were recognized as immediate expenses under both US GAAP and IFRS. No difference there.
Right.
However, they also had $197 million in late-stage development costs that met those strict criteria for capitalization under IFRS.
So let's run the US GAAP impact first. Under US GAAP, that $197 million is treated like a lottery ticket. It is immediately expensed. You add it to the $727 million base, and you get a total R&D expense hitting the income statement of $924 million. That directly reduces pre-tax income.
Now let's run the IFRS impact. That same $197 million in development cost is not expensed. It is moved to the balance sheet as an intangible asset. You're stacking the bricks.
However, the income statement isn't completely shielded forever. C&H must amortize the development costs they capitalized in previous years, matching the expense to the revenue those completed projects are now generating.
Makes sense.
In 2024, that amortization of historical projects was $71 million. They also had to take $11 million in impairments on previously capitalized projects that perhaps became technologically obsolete.
So under IFRS, the total expense hitting the P&L is the $727 million in base research, plus $71 million in historical amortization, plus $11 million in impairment. That totals $799 million in IFRS R&D expense.
Exactly. So for the exact same underlying economic activity, the exact same engineers doing the exact same work in 2024, US GAAP reports $924 million in expense, and IFRS reports $799 million.
Wow.
That is a $125 million difference dropping straight to the pre-tax bottom line.
That is massive. If you are applying a 15x multiple to that, it completely changes the valuation of the company.
It really does.
But the real story isn't just one year's income statement. It's the balance sheet accumulation over time. If you look at C&H's equity section, they have roughly $800 million sitting in retained earnings under IFRS that US GAAP has already flushed through the P&L as historical expenses over the past decade. The IFRS balance sheet is significantly larger, and its retained earnings are significantly higher.
And this brings up a fascinating debate about the quality of these capitalized assets. Is IFRS just allowing companies to inflate their balance sheets with phantom, unproven assets? Or does this capitalized development actually predict future commercial success?
Because if it's just phantom assets, the US GAAP method of expensing everything is much safer for the investor.
Right. But academic research provides a compelling answer. Studies looking at EU high-tech and industrial firms show that development costs capitalized under IFRS actually have a statistically stronger association with future patent counts and future patent citations than standard expensed R&D.
Wait, really? That is a massive insight. Because IFRS forces companies to rigorously segregate the highly uncertain research from the technically viable development, that capitalized asset line item actually serves as a strong signal of successful late-stage innovation.
Exactly. It predicts actual patent generation better than gross R&D spend. If you are analyzing an IFRS, tech, or industrial firm, you shouldn't just view capitalized development as an accounting gimmick.
Right.
That line item is a proxy for the maturity and viability of their innovation pipeline. It separates the noise of early-stage failure from the signal of late-stage commercialization.
So we've seen how IFRS can inflate the asset side of the balance sheet through revaluation and capitalized development. We've built the company up.
Time to tear it down.
Now let's look at the dark side of the balance sheet. The liabilities, the write-downs, and the hidden burdens that drag a company down.
Let's start with lease accounting. A few years ago, both the FASB in the US and the IASB internationally introduced new, highly anticipated lease standards, ASC 842 for GAAP and IFRS 16. The goal was to end one of the biggest off-balance sheet financing tricks in history.
Right. It used to be that if you signed a 10-year lease for a massive flagship retail store, it didn't show up on the balance sheet at all. You just expensed the rent every month.
Both standard setters effectively killed the off-balance sheet operating lease. Today, if you sign a long-term lease for a factory or a fleet of airplanes, both standards require you to recognize a right-of-use asset and a corresponding lease liability on the balance sheet.
So they agree on that.
Yes, they agreed on day one accounting. The balance sheets look essentially the same on the day you sign the lease.
But day two accounting, meaning how that lease actually flows through the income statement over the next 10 years, is entirely different. And it creates a massive divergence in operating metrics.
Let's look at the mechanics. Under US GAAP, operating leases are treated as a single, straight-line total lease expense that sits entirely within operating income.
Okay.
Every year, the rent expense is identical, and it's entirely above the EBITDA line. It reduces your operating profit.
IFRS 16 takes a radically different approach. It essentially says there is no such thing as an operating lease anymore. If you sign a 10-year contract for an asset, you effectively bought it with debt.
Exactly.
Therefore, IFRS treats all leases as finance leases. The total expense is split into two components: the depreciation of the right-of-use asset and the interest expense on the lease liability.
The practical application of this split is profound. First, consider the timing of the expense. Think about a standard mortgage.
Right.
Because an amortizing liability has the highest principal balance in year one, the interest portion of the expense is heavily front-loaded. It is highest in year one and declines over the life of the lease. The depreciation, meanwhile, is straight line.
Therefore, the total P&L expense under IFRS is front-loaded compared to the perfectly straight-line rent expense under US GAAP.
Correct.
In the early years of a massive new lease portfolio, an IFRS company will report a lower net income than an identical US GAAP company simply because of the math curve.
But the more insidious distortion happens to EBITDA, and this is critical for valuation. Under US GAAP, the entire lease payment is an operating expense. It reduces EBITDA. Under IFRS, the expense is split into depreciation and interest.
And where do depreciation and interest sit? They sit below the EBITDA line, earnings before interest, taxes, depreciation, and amortization.
Exactly. Therefore, if you take an identical company with massive operating leases, say, an airline like Lufthansa versus Delta, moving them from US GAAP to IFRS will artificially, mechanically inflate their EBITDA by hundreds of millions of dollars.
Wow.
Simply because the lease expense was reclassified out of operations and down into interest and depreciation.
This is the aha moment for anyone building a screen. If you are running a standard quantitative EV to EBITDA screen right now, every European airline, every European retail chain with massive store footprints will mathematically look like a screaming bargain compared to their US peers.
Absolutely.
And it has absolutely nothing to do with how many tickets they are selling or how well they manage operations. It is purely an optical illusion created by IFRS 16.
You have to adjust for it. You must manually add the lease interest and depreciation back into operating expenses for the IFRS company, or alternatively, capitalize the operating leases for the US company to ensure comparability. You just cannot trust the raw EBITDA feed.
Now, let's move from the slow bleed of lease expenses to the sudden shock of impairments. How do companies write down long-lived assets like factories or intangibles when the economics of the business collapse?
US GAAP uses a very specific two-step impairment test.
Yeah.
Step one is the recoverability test. You ask, are the undiscounted future cash flows expected to be generated by this asset less than its carrying amount on the balance sheet?
And if the answer is yes, the asset fails step one, and you proceed to step two, which is measurement. In step two, you write down the asset to its fair value, which is usually calculated using discounted cash flows.
Contrast that with IFRS, which skips the two-step dance and uses a single-step test. IFRS simply compares the carrying amount directly to the recoverable amount. The recoverable amount is defined as the higher of the asset's fair value, less costs to sell, or its value in use. Crucially, value in use is calculated using discounted cash flows right from the start.
So what is the practical result of US GAAP using undiscounted cash flows for that first step? Let's bring in the time value of money. An asset's undiscounted cash flows over 20 years will always be significantly higher than its discounted present value. $1 tomorrow is worth less than $1 today.
Exactly. Therefore, an asset might be economically impaired. Its true fair value today is well below its carrying amount on the books. But because the simple sum of its undiscounted future cash flows still technically exceeds the carrying amount, It passes step 1.
So US GAAP completely shields the income statement. No impairment is recognized, even though the asset is technically economically underwater.
US GAAP fundamentally delays the recognition of impairment. It requires a much deeper, more severe deterioration in the asset's economics before a write-down is triggered.
Oh, I see.
Think back to the financial crisis. Many U.S. assets were kept on the books at inflated values for far too long because of this undiscounted cash flow test. IFRS, by using discounted cash flows immediately in its single-step test, forces companies to recognize economic reality and write down assets much earlier.
And as we mentioned with inventory, remember that IFRS allows for the reversal of these impairments in future years if the asset recovers, with the strict exception of goodwill. US GAAP strictly prohibits all impairment reversals. Once you take the hit, it stays down.
Which brings us to another area of liability recognition where timing is everything: provisions and contingent liabilities.
Let's talk about provisions.
When does a company actually have to book a hard liability on the balance sheet for a pending lawsuit, an environmental cleanup, or a major corporate restructuring?
Well, under US GAAP, you recognize a provision when the loss is considered probable and can be reasonably estimated. But in actual audit practice, how is probable defined? It is typically interpreted as a very high hurdle, usually around a 70 to 80% likelihood of occurrence. You essentially have to be certain you are going to lose the lawsuit.
IFRS also requires recognition when a loss is probable. However, IFRS explicitly defines probable in its standard as simply more likely than not.
Wait, really? That is a threshold of anything greater than 50%? It's basically a coin flip?
The implication for the balance sheet is massive, because the probability threshold is essentially a coin flip under IFRS versus a near certainty under US GAAP. IFRS companies will recognize legal liabilities, restructuring provisions, and environmental cleanups earlier and far more frequently than US GAAP companies.
So an IFRS balance sheet will likely have more provisions recognized, making the company look artificially more legally riskier burden. Whereas a US GAAP company might just disclose that 60% likely lawsuit in the footnotes as a contingency without ever taking the hit to the actual balance sheet and income statement.
Exactly. It changes the perceived risk profile of the company. Having dissected the internal mechanics of assets and liabilities for a single entity, we must finally address how these standard setters view the corporate perimeter itself.
The perimeter.
Yeah. How do companies consolidate their empires, and how do they account for their investments in others?
This is a crucial area for anyone looking at holding companies or complex conglomerates. Let's look at the exception for investment entities. Both frameworks have standard rules for consolidating subsidiaries. Generally, if you own more than 50% of the voting rights and have control, you consolidate.
Right.
You combine the financial statements line by line. Your revenue becomes their revenue.
But IFRS 10 carved out a major pragmatic exception for investment entities. Think about private equity funds, venture capital firms, or massive sovereign wealth funds.
Right. Imagine a private equity fund that owns 100 different companies across 100 different industries.
Right.
If they had to consolidate all of them into one massive financial statement, it would be unreadable. You'd be adding software revenue to steel manufacturing revenue. It would be a useless document for an investor.
Precisely. So instead of consolidating their subsidiaries, an investment entity under IFRS measures its investments at fair value through profit or loss, or FVTPL. They just show the fair value of the portfolio company as an investment line item, and the changes in value flow through the income statement.
To qualify for this IFRS exception, the entity must meet strict criteria. The primary requirement is that it must measure and evaluate the performance of substantially all its investments on a fair value basis. Its stated business model has to be investing for capital appreciation or investment income, not operating a massive conglomerate.
US GAAP has a similar concept under Topic 946 for investment companies, but the scope has a distinctly American regulatory flavor to it. The US GAAP exception explicitly includes entities regulated under the Investment Company Act of 1940.
Furthermore, under US GAAP, these investment companies are required to fair value their equity method investments as well. IFRS is more nuanced. An IFRS investment entity still has to consolidate a subsidiary if that subsidiary's main purpose is simply providing services related to the investment entity's own activities, like a management company shell, rather than being a true portfolio investment holding.
Moving down the ownership spectrum, what happens when you don't outright control a company, but you have significant influence? Usually this is presumed when you hold 20 to 50% of the voting power.
Both standards use the equity method here. You record the investment as an asset on your balance sheet, and you recognize your proportional share of the investee's net income on your income statement. It's a one-line consolidation.
Right.
But the threshold for what instruments actually qualify for the equity method diverges.
The mechanics of the threshold matter deeply when dealing with complex financial engineering. US GAAP applies the equity method strictly to common stock or in-substance common stock.
Which means?
In-substance common stock means instruments that have a risk and reward profile substantially similar to the bottom tranche common equity.
So if Wall Street engineers a complex instrument, say you hold a massive block of preferred stock or convertible debt in a startup, you generally don't use the equity method under US GAAP, even if you effectively hold 30% of the economic voting power.
IFRS takes a broader, more economic substance view. IFRS applies the equity method to any instruments that give the holder current access to the returns associated with an ownership interest.
Oh, that's interesting.
Yeah, if your complex preferred shares give you current access to the underlying economics and dividends of the business, IFRS puts you on the equity method.
So an American company could use complex preferred structures to avoid showing the losses of an investee on their income statement, while an IFRS company would be forced to recognize their share of those losses via the equity method.
Exactly. It prevents hiding bad investments behind structural loopholes. Now, theory, mechanics, and structural differences only matter if you can actually use them to generate alpha in the market or to pass your exams.
We've covered a massive amount of ground. Let's bring this all home. For the practitioner, the valuation modeler listening right now, what is the ultimate takeaway?
The lesson is that you cannot run automated global quantitative screens without making manual surgical adjustments.
Right.
If you run a straight EV to EBITDA screen on a global universe of retail or travel stocks, the IFRS companies will mathematically look artificially cheap because their operating lease interest is buried below EBITDA. You must manually add the lease interest expense back into the operating expenses for the IFRS company to compare it to the US GAAP straight-line lease expense.
Furthermore, if you are analyzing return on invested capital for industrial tech firms, you cannot just take the reported asset base.
Nope.
You must strip out the capitalized development costs from the IFRS company's balance sheet and run those amortized costs back through the historical P&L as immediate expenses to accurately compare their R&D efficiency and ROIC with a U.S. peer. You have to undo the capitalization to find the true cash-on-cash return.
And for the CFA candidate listening to this, you need to know how the examiners will test these mechanics. Level A focuses heavily on directional relationships.
Okay.
They aren't going to make you do a 10-year LIFO conversion, but they will ask. If an IFRS company classifies interest paid as a financing cash flow instead of an operating cash flow, what is the directional impact on CFO?
And the answer is that it artificially increases CFO relative to a U.S. peer.
As you move to level 2 and level 3, the exam demands the actual mathematical adjustments. You will be tested on adjusting a U.S. LIFO firm's statements to FIFO.
Oh yeah, the math.
You must know to add the LIFO reserve to the inventory balance on the balance sheet and subtract the change of the LIFO reserve from COGS on the income statement.
You must also know the geography of reversals. You need to know that an IFRS impairment reversal flows directly through the income statement and boosts net income, whereas an upward revaluation of PP&E completely bypasses the income statement and hits other comprehensive income. The mechanics dictate the math.
You really have to know where the numbers go.
When you are staring at a massive valuation gap between a U.S. firm and an international peer, the one question you must always ask is, if we force these two companies into the exact same accounting framework, does the valuation premium still exist?
Because true alpha is found in the underlying economic reality of the business, not the optical illusions created by its accounting regime.